You found a rental property deal, you got a hard money lender to fund it, and then you hit the wall almost everybody hits. The lender covers 80%, and you're on the hook for the other 20%. That 20% down plus closing costs is the gap. And that gap is where most deals quietly die. So let's fix that. I'm going to give you 3 ways to cover that gap. And with a couple of them, you can close the deal without pulling much or any of your own cash. I've funded these types of deals since 2008. So I'm going to show you how to do it. Let's go. Now, real quick. So we're working with the same numbers. Say the purchase price is $200,000. Your hard money lender is going to fund 80%. That's $160,000. Good. But that leaves $40,000 you have to bring to the table, plus a few thousand in loan fees and closing costs on top of that. That 40+ thousand is the gap. Everything I'm about to show you is a different way to fill that gap. So let's talk about method number 1. Method number 1 is cross-collateralize with equity you already have. If you already own property with equity in it, a rental, a paid down house, you may not need cash for that gap at all. You can use the equity in that property instead. There are 2 ways to access that equity. The first is a HELOC, a home equity line of credit against that property you own. You get that from your bank or credit union. You draw the $40,000 off that line of credit, use it as your down payment on the new property purchase, and pay it back as the deal plays out. The equity is already yours. You're just putting it to work using a HELOC. The second way to get access to that equity in the property you already own is called cross-collateralization. And this is one a lot of investors don't know to ask for. Instead of you pulling cash out of the property using a HELOC from your credit union or bank, with cross-collateralization, the lender takes both properties as collateral for the loan. Now the loan is backed by 2 properties instead of 1. The lender's risk drops, and they can even reduce or wipe out the cash you need to bring in. We do this at High West Lending when a borrower is equity rich but cash light. Here's the real talk. You're putting a property you already own on the line to get the next one. If the new deal goes sideways, you've now got 2 properties exposed instead of 1. So this works when your numbers are solid, not when you're stretching to make a thin deal work. Use it only on strong deals. Don't use it to rescue weak deals. Method number 2, bring in a gap funder or money partner. Someone else brings in the $40,000. This is what people usually mean by gap funding, right? A private individual or partner funds the down payment gap so you don't have to. And you can structure this gap funding 2 different ways. The first way is as a debt. The gap funder lends you the $40,000 and puts a lien on the property behind your hard money lender in a second position. They get their money back plus interest or a set fee when you exit, which is a refinance or sale. They're not a partner, they're a short-term lender providing a second mortgage or second trust deed behind your hard money lender's first mortgage or first deed of trust. Now, the other way to do it as a gap funder is as equity. Instead of a fixed return, the gap funder brings the cash in exchange for a share of your profit on the deal. No additional debt added to the property, but now you're splitting the profit with an equity partner. So, which one is better, debt or equity? Well, it depends on your margin, your profit margin. If the deal's got a fat profit margin, debt is cheaper. You pay interest or a flat fee and keep the rest of the profit. If your profit margin is tighter or a deal is riskier, then an equity partner is going to share the downside with you, right? So that's a better way to go. Let me put quick numbers on it so you can feel the difference. Say the deal makes a $50,000 profit. A debt partner on that $40,000 gap that you need might cost you $5,000 in interest or fees. Done. You keep the other $45,000 in profit. An equity partner splitting the profit 50-50 costs you $25,000. Same gap, same $40,000 you needed, a lot different cost. So know exactly which one you're signing up for before you agree on it with your gap partner or your gap funder. Now the real talk on method number 2, and this is the big one. Your first position hard money lender has to know about and approve that second position money if you're doing it as a debt or equity. Bringing in a silent gap funder that your main hard money lender doesn't know about can violate your loan terms and blow up the whole deal. Do it in the open. A clean, disclosed second position gap funder or partner is a tool that lenders work with all the time. But if you hide it, it's a good way to lose the deal and your relationship with your hard money lender. Method number 3, seller carryback. Method 3, it's my favorite when it's available because the money can come from the person selling you the property. It's called a seller carryback or a seller second. Here's how it works. Instead of the seller taking all of their cash at closing, they agree to carry part of the price as a loan to you. So, on our $200,000 deal, the seller might carry the $40,000 gap. You pay them back over time on terms you agree to. That carryback covers your down payment and you bring in your closing costs and loan fees on the hard money loan that will be in a first position on the property. And your seller will carry the $40,000 in a second position behind your hard money lender. This works best where the seller doesn't desperately need every dollar at once. A paid off property, a tired landlord, an inherited house, an off-market deal. Those are examples where you're able to negotiate with the seller. And those are the types of sellers that may consider doing a seller carry. The real talk here is 2 things. 1, same as before, your hard money lender has to approve a seller second behind its first lien. And the hard money lender has to be okay with you bringing in no money except your closing costs and loan fees. It has to be disclosed. And your hard money lender, it has to fit their guidelines. And then 2, you actually have to ask, and most people never do. Sellers won't offer to carry. You have to bring it up, explain it plainly, and show them why getting paid over time on a portion of those funds can work in their favor. Sometimes for tax reasons, sometimes just to get a stuck property sold. The seller needs to understand that the gap amount that they're carrying will be in a second position behind your hard money lender, right? The worst they can say is no. So there's your 3. Use equity you already own, bring in a gap funder or partner, or get the seller to carry it. These financing secrets can be used on rental property purchases and fix and flips. But here's the honest truth about these secrets. They aren't secrets. They're secrets to most real estate investors because nobody teaches you how to ask for them. So the gap stops people cold when it doesn't have to. Now, you know how to ask. And there are 2 rules that tie all 3 methods together. First, the deal has to be good enough to carry the extra cost because filling the gap always costs something. Interest, a profit split, or a payment to the seller on a seller carry. Creative financing makes a good deal doable, but it does not make a bad deal good. Second, whatever method you use, keep your hard money lender in the loop. Disclosed and approved keeps the deal alive. Hiding things from your hard money lender is gonna blow up your deal every single time. And if you've got a deal and you're trying to figure out how to structure the gap, cross-collateral, a second position, a seller carry, all ways of structuring financing that we know how to do at High West Lending. Links in the description, bring me a good deal and we'll figure out how to close it.